Bill Ackman, the billionaire hedge fund manager and investor, has some strong words about inflation and the Federal Reserve Bank. He says that the Fed needs to change their policies quickly before it's too late. What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com, where money minds rethink rich. Let me read you this tweet from the billionaire hedge fund manager Bill Ackman. He says that he gave a presentation to the Federal Reserve Bank about his views on inflation and Fed policy, and his bottom line is that he thinks that the Fed should taper their money printing immediately and start raising rates as soon as possible. And he followed up by saying that we are continuing to dance while the music is playing, and it's time to turn down the music and settle down. Inflation is really starting to become a big deal. I mean, it has been a big deal for a while, but it's becoming a bigger deal because you have regular people really starting to see the price and the effects of inflation, and now they're starting to get worried. Let me kind of diagram the inflation journey that we've been through. Inflation really started to hit the headlines in the early part of 2021 because in April 2021, that was when the inflation rate hit the highest levels that we've seen since 2008. People naturally started to get a little worried because we saw an excessive amount of money printing in 2020 and 2021, but that's when the Federal Reserve Bank came out and they reassured the American people because they said that this inflation that we're seeing is transitory, it's temporary, and there's nothing for you to worry about. By July of 2021, the Federal Reserve Bank came out and they said, I told you so, because it looked like the price of things were finally starting to come down because inflation was starting to ease. But then came August, and that's when people started to realize that yeah, inflation has cooled down since the early part of 2021, but it's still really high. And so the price of things are still very expensive. And now, yeah, we might be seeing inflation cool down a little bit, but the price of things are still so expensive, making it hard for people to afford life. Then in September, inflation took a turn for the worse because inflation started ramping up again, and the prices of things were still already getting higher, but now they started getting higher even faster. Then came October. And that was when crap really started hitting the fan because we saw some of the highest inflation levels in October that we've seen in more than 30 years. And that's when people really started to get worried. That's why in November, the Federal Reserve Bank came out again and they said, yes, we know that people are experiencing some inflation right now, but don't worry. This inflation that you're seeing is still transitory. We got it under control, and we're gonna start tapering some of our bond purchases. We're gonna start tapering some of our money printing, but we're not gonna touch interest rates yet because inflation really isn't that bad. It's just gonna go away. Don't worry. Now at this point, you might be thinking something along the lines of, what's the big deal? The Federal Reserve Bank and the government have a lot of resources that we don't have access to, and if they keep telling us that this inflation is transitory and it's gonna go away soon, why are you so worried about it? Why do you keep talking about it? I mean, they said it's gonna go away. Why can't we just trust them? It's a pretty fair point. Why wouldn't you want to trust the people who are in power? Now, the trust issues that I have come from the fact that they've been wrong and lied to the American people time and time again. Like if we go back to before the 2000 dot-com bubble bursting, Alan Greenspan, who was then the chairman of the Federal Reserve Bank, kept coming out and said that there's no stock market bubble. There's nothing that you have to keep worrying about. And then when the bubble burst, people realized that he was wrong. And lots of people lost a lot of money. Before the 2008 crash, Ben Bernanke, the then chairman of the Federal Reserve Bank, kept coming out and saying that there's no housing bubble. There's nothing that you have to worry about in the housing market. And then came 2008. And the housing bubble imploded, and then lots of people lost a lot of money again. Now we're in a situation where we have printed a record amount of money in 2020 and 2021. We still have very low interest rates. The Federal Reserve Bank is still buying back bonds, although they've tapered their bond purchases. They're still printing money to buy back some of these assets. And everyone keeps saying that this inflation that we're seeing is transitory. The chairman has come out time and time again and said that this inflation is transitory. It's just going to go away. But what if he's wrong? This is where you want to make sure that you're making smart decisions with your money. Because if, let's assume that the Federal Reserve Bank is right and this inflation is transitory and you made smart decisions with your money to protect your assets today, well, nothing really happens because you made smart decisions to protect your money and inflation wasn't as bad as it was. So you protected yourself, but it's really not that big of a deal because inflation went away. But let's just assume now that the Fed is wrong. And this inflation really doesn't go away, and we continue to see high inflation into 2022 and 2023. And now, if you don't do anything, well, now you're the one paying the price because you're poorer, your savings don't stretch as far, your paycheck doesn't stretch as far. But if you make the right decisions with your money, well, now you are benefited and you protected yourself. So it's in your best interest to do the best things with your money today. That way you can protect your wealth and protect your money just in case inflation doesn't go away. And if inflation does go away, well, you're still okay because all you did was make smart decisions with your money. You have to start by understanding what is inflation, because most people assume that inflation is when the price of things go up. But that's not really what inflation is. That's a side effect of inflation, but inflation is not the price of things going up. Inflation comes from the word inflate, which means to increase the amount of something. So if I told you to inflate that thumbs up button, now you're inflating that thumbs up button below. But in this case, what are we inflating when we talk about inflation? We're inflating the monetary supply, the amount of dollars out there. When you inflate the amount of dollars out there, what that does is it devalues your currency, because now the value of each individual dollar that you have goes down. If you have a limited supply of a needed and usable resource that people want, the perceived value of this resource goes up. But if you have a huge supply of this resource that people want and that they need, but you have an abundant supply, well, now it doesn't really have that same perceived value because you have so much of it. Just think of toilet paper. When the 2020 pandemic happened and you saw this shortage of toilet paper, now all of a sudden the perceived value of toilet paper was very expensive. Some people were dealing individual rolls of toilet paper for $25 a piece. But when you have an abundant supply of toilet paper, it's just toilet paper. No one really cares about it. Our dollars work the same way. Our dollars are not backed by anything tangible. Our dollars are not backed by gold or silver or Bitcoin. Our dollars are just pieces of paper. Now, the reason why our dollars have value is because the United States government has said that our dollars are value and you need to make transactions with the dollar. So now our dollars have value, not because of the intrinsic value of the piece of paper, but because the government says that we can make transactions with this dollar. That's why if you go to a store and you pay somebody with a $100 bill, they'll accept this $100 bill because they know that it's backed by the full faith and credit of the United States government. So the United States dollar is the world's reserve currency, and it's backed by the United States government because the government is the strongest government in the world. It has the strongest military presence, and right now we have the strongest economy in the world. This helps support the value of the dollar. But now what would happen if I just increase the monetary supply? I just increase the amount of dollars out there without having people actually earn this money. It wasn't produced. You didn't have people actually working to earn this money. I just printed this money out of there, and then I took these new dollars and injected it into the economy. Well, now what people are going to realize is, hey, this $100 isn't worth what it was before because you have an ample supply of dollars. So now if I want to go and buy something, I have to pay more than $100. Maybe I got to pay $105 because there's more dollars out there. So inflation is when you increase the amount of dollars out there, and generally this causes the price of things to go up, but not always. Sometimes you see the price of things go down when you see inflation. But the reason why these things go down is not because you have inflation, it's because of other things. Maybe you have technological improvements in the world, or maybe you increase the supply chain issues, or you do something to make the cost of this product go down. Now, the reason why this product didn't go down further now is because you saw inflation. If you didn't have any inflation, then the price of this product probably would have fell further, but it didn't because you saw inflation. So you can still see the price of things go down if you see technology improve, if you see supply chain issues improve, if you see efficiencies improve, but it won't go down as far if you have more inflation, because inflation is devaluing the currency that you're using to buy this thing. One way that you can create more inflation is just by printing more money. If the government spends more money than it has, well, now it has to print that money unless they can get that money from taxes, but they will never be able to raise enough taxes to cover all of their spending. So if they spend more than they earn from taxes, then they got to print that money. And so now this freshly printed money causes inflation, and the person that pays the price of this new printed money is the average person. See, when the government creates a tax on corporations and they use this tax on corporations to pay for their spending, you know exactly who's paying for it. Corporations. Now, corporations might try to funnel this cost of taxes down to the consumer, but you know exactly where the money's coming from. When the government now doesn't have enough money to cover their spending and they just print the money, then who pays the cost of it? Because somebody does have to bear the burden of the cost. Then, when they just print the money, the person who bears the burden is the person who doesn't understand what inflation is. It's the financially uneducated. Because now, when you don't have that financial education, now life just becomes more expensive. Because you're going to work every single day, you get a salary, but your salary doesn't stretch as far because your rent keeps getting more expensive, your groceries keep getting more expensive, your gas keeps getting more expensive, your vacations keep getting more expensive, your healthcare keeps getting more expensive, but your income isn't keeping up. This is where a lot of people will say things like, but if you see inflation, your salary is supposed to go up too. And you're right. You will probably get some raises, or hopefully you'll get a raise to help you counteract this inflation. But what you'll see happen a lot of times is your wage raises won't be enough to cover the actual inflation that you feel. Because The government and the media have these inflation indices that they look at. They look at CPI, they look at PCE. But these are just subsets of data. The inflation that you feel is different than what somebody else's feels. Because if you're trying to go out and buy a car and cars are 30% more expensive, well, now that inflation really hurts you more than somebody who's not buying a car. And if you're going to renew your lease and your lease is now 15% more expensive than before, well, that inflation hurts you more than somebody else. The second way that you see inflation happen is through interest rates. Because when interest rates are lower, what happens? People want to go out and get a mortgage. They want to go out and borrow money. Corporations want to go out and borrow money because they want to take advantage of these low interest rates. Institutions want to go out and they want to borrow millions and millions of dollars. That way they have extra cash to inject back into the stock market. So when you lower interest rates, people borrow more money because money is cheap. And now you have more dollars being printed because banks don't have these billions or trillions of dollars sitting in deposit. They borrow this money from the Federal Reserve Bank. So when people go out and borrow money from the bank gets this money from the Federal Reserve Bank. So the Fed prints this money out of thin air. They give it to your bank gives this money to you. So when interest rates are lower, people are more likely to go out and borrow money, which in turn causes more inflation because more money is printed, which enters our economic circulation. So you can really start to see that everything in the economy is a double-edged sword. It has its pros, it has its cons. When interest rates go down, you can go out and borrow money for your home very cheaply. But now you also have very low interest rates on your savings accounts. So if you save money in the bank, you're not earning anything. You're actually losing value because your dollars are being eaten away by inflation. And although you got to borrow money super cheap, now you're also contributing to inflation because you borrowed more money. So more money enters our economic circulation, which in turn devalues each individual dollar. And this brings me back to the Bill Ackman tweet where he told the Federal Reserve Bank that they need to stop their tapering. They need to stop buying back these bonds by printing money in order to do that. And they need to raise interest rates. The reason why he's saying that is because now he's getting worried about inflation. The reason why this is so interesting is because he runs a very successful hedge fund. And the way that they make money is by investing their money into companies and into stocks. What happens to the valuation of companies and stocks if you see inflation? Well, if you see moderate amount of inflation, it's really good for stocks and companies because now your valuation goes up. You have more cheap dollars entering the economy. You have more dollars entering our economic circulation. So people have more dollars to go out and spend at these companies. So these stocks now look like they have bigger profits, they have bigger revenues, and they also have more dollars to invest into these companies because now people can borrow money cheaply. You have more dollars going into the market. So now the valuation of your investments are higher because you have more dollars flowing to the top. Inflation causes the rich to become richer and the poor to become poorer. So if you see a moderate amount of inflation, it's actually good for hedge funds because now they're the ones that are benefiting because they own the means of production. They own the companies, they own the stocks. But again, it goes back to the double-edged sword. A little bit of inflation, not a bad thing. It's good for the investors. It's good for the people that understand how to use their money. It's good for the financially educated. But a lot of inflation, well, now that's where this inflation can start to hurt you. So I actually went through the presentation that Bill Ackman gave to the Federal Reserve Bank. I know, I'm a money nerd. And on the third slide of the presentation that he gave to the Federal Reserve Bank, it had this highlighted portion where he said a quote, wait and see approach, which is what the Federal Reserve Bank is doing to raising interest rates, creates significant risks given the substantial progress to date on employment and inflation combined with the unprecedented economic backdrop. The Federal Reserve Bank wants to see more inflation because they say that if you see more inflation, that we will be able to grow our economy. Right now, we're at a point where we still have a lot of people that are not working. We have a high unemployment rate. We have the economy growing relative to 2020, but still relative to where the economy should be. Our economy is not fully functional. Our economy is not running as fast as we would like. So yeah, our economy is growing. People are starting to go back to work, but we're not where we want to be. And so the Federal Reserve Bank feels that the way that you get people back to work, the way that you get the economy growing again, is by creating more inflation. If you print more money, we can create more stimulus programs. And if we keep interest rates low, businesses and people will be able to borrow money cheaply. And if they can borrow money cheaply, well, then people will be buying more homes. If people are buying more homes, the real estate industry is booming. Now you have real estate agents that are getting paid. You have mortgage bankers that are getting paid. You have banks that are getting paid. You have title companies that are getting paid. You have contractors that are getting paid. And so that keeps the economy moving. And if corporations can borrow money very cheaply, well, now they can borrow money cheap and they can reinvest this money back into the company to open up a new store, to open up a new manufacturing plant. They can hire more people, and this will help get the economy moving. But the price that we pay for that is now inflation. Inflation now increasing the monetary supply, which in turn causes the price of things to go up. You have this real delicate balance where the Fed is saying, hey, let's just try to increase inflation. That way we can get the economy moving and get things back to normal. But if we hit too much inflation, well, now you can crash the dollar. You can create a dollar crisis where people lose faith in the value of the dollar. We've seen this type of debasing of currency happen time and time again throughout history, and we've seen what it causes. The Roman Empire used to debase the value of the silver when they wanted to grow their empire, they wanted to grow their military presence, they wanted to grow their infrastructure. It created a boom in the short term, but it ultimately led to the collapse of the Roman Empire. We saw it happen in Venezuela. Venezuela printed a whole bunch of money because they wanted to help grow the economy. And in the short term, it was booming. People looked at Venezuela as the country to be because they're taking such good care of their citizens because they were printing so much money to do it. And then ultimately, the Venezuelan economy collapsed because the value of their dollar crashed. You saw it happen in the Weimar Republic. They were trying to pay off their debts for the war that they lost. They just kept printing and printing and printing. And then ultimately, the value of their dollar, their currency, collapsed, and then so did their country. Now, looking for the United States has the strongest military presence in the world. The United States has the strongest economy in the world. The United States is the strongest country in the world, and the dollar is the world's reserve currency. So the United States has that going for it. And you have countries around the world, many countries around the world, that are causing way more inflation by printing more of their currency than of the United States itself. But you still have to worry about the dollar. I mean, sure, relative to the rest of the world, the dollar is still the strongest, but what happens if we continue with this inflation? And if we take a step back and look at this from a broader perspective, why isn't the Federal Reserve Bank and the government more worried about inflation? I mean, even if they think it's transitory, people are still really hurting because of this inflation, but why aren't they worried? You have countries around the world that are starting to issue warning signals about inflation. You have huge hedge fund managers that are issuing warning signals about inflation. You have a huge chunk of the population that is worried about inflation, if not everybody is worried about inflation. So why isn't the Fed and the government more worried about inflation? There's a couple of reasons for that. The first reason is more on an emotional reason, because if the Fed came out and they started saying that inflation is a real problem, then people would start to panic and people would start to get really worried. And that would mean that the Fed would have to start fighting inflation. And the way that you fight inflation is by decreasing the monetary supply. So you'd have to see the Fed really start to ramp up interest rates, and you'd see them start to cut down their spending and their stimulus. And that could create a crash in the stock market and the real estate market and just a whole bunch of asset classes, because as you raise interest rates, borrowing money becomes more expensive. And now it'd be harder for these asset classes to continue having people dump their money into these asset classes. And they don't want to see a crash happen. I mean, the Federal Reserve Bank worked so hard not to stop their asset purchases because they were worried about a taper tantrum. A taper tantrum happened after the 2008 crash, because after the 2008 crash, the Fed started printing money and they started using this money to start buying back bonds, to start buying back assets, to keep investors confident, to keep investors pouring their money into the markets. But as soon as they stopped that, they saw something called a taper tantrum. It was a mini stock market crash, and they didn't want to see that happen again. And so now in 2020 and 2021, the Fed opened up the money printer and they were buying $150 billion worth of assets every single month. And they really tried so hard not to stop it, because if they stopped it, they were worried about a taper tantrum. They said that again and again and again. The reason why they can't stop this taper tantrum, even though the stock market has recovered, even though they feel like the economy is recovering, is because they're worried about a potential stock market crash. Now, relative to everything else, a taper tantrum is just this much. And so if they were that worried about tapering these asset purchases, don't you think they're going to be more worried about really jacking up interest rates, because that would cause stock market prices to go down? They're worried about creating a crash, so they don't want to see that happen. And if people were worried about inflation, if people really worried about what was going to happen, and if the Fed was worried, well, then people would panic, and they don't want to see that happen. The second reason is more of a financial reason. Right now, the United States government has something around $29 trillion worth of national debt. If you see more inflation, then the value of your dollar goes down. Now, if the value of your dollar goes down, now this debt becomes less expensive, because now you can pay back this $29 trillion with cheaper dollars. So it's in the government's best interest to inflate away this national debt, because that's the only way that they'll ever have a chance to pay it off. The United States government has to pay back some payments on this debt. It's kind of like your credit card. If you go and run up your credit card bill, you have to make minimum payments on it. And if you increase your credit card bill even more, your minimum payments go up. It's the same thing with the United States government. They jacked up the national debt in 2020 and 2021 and going into 2022. And now they have to pay this money back. Well, the only way they can afford to pay this back is either raising taxes, which they're trying to do, but they need inflation to continue. That way they can continue to pay this money back with cheaper dollars. So now, what does this mean in practical terms, and what can you do? Well, in practical terms, what this means is your cash is losing value relative to inflation. So you need to do something with your cash to turn your cash into an asset that will either grow at or faster than inflation by owning something that's producing value, or own something that's going to at least maintain its value. That way it's an inflationary hedge. That way now if you start to see more inflation, you can always sell this, and now you can use the proceeds from the asset that you sold to go out and buy more assets, to buy more investments. The people that benefit from inflation are the people that are financially educated. These are the people that are buying assets, things like stocks and real estate, because now as more inflation happens, the value of your assets go up. If you would have just kept that cash in your bank account, the buying power of your cash is going down while the price of stocks and real estate go up. So when you see more inflation, it becomes harder for you to go out and buy stocks and real estate, because now the price of those assets keep going up while the value of your dollars aren't changing. Because if you just keep your dollars in your bank account, well, your dollars are dead. They're not doing anything. They're not growing. But the price of everything around you keeps getting more expensive. This is where the first thing you have to do is get financially educated. That way you can start investing your money into stocks and real estate the right way, making smart decisions. That way you can convert your cash into actual investments, into actual assets, because now you own a productive asset. When you own shares of a company, well, this company is working to produce more value because they have employees. They're trying to increase their revenue. They're trying to create new products. So you own shares of a company that's working to produce more value. With real estate, you own an actual asset. You own a home, you own an apartment complex, you own a building which you can rent out. And so now if you own a building in a good location, you'll see rental values go up, you'll see the value of your property go up, so you're protecting yourself and benefiting from inflation. This is why the people that benefit from inflation are the wealthy, the financially educated, people who understand what inflation is. And then you have the protectionary route. We'll talk about that in just a second, but if you do want to learn more about how to invest your money in the stock market and the real estate market, you can check out our Market Insiders program. This is a weekly coaching session, group coaching session, where you'll learn not only how to invest your money, but you'll also be able to apply the lessons that you learn in your coaching class to what's happening in the world, because all of your coaching lessons are live. So in 1 week stock lesson, you might learn how to read a profit and loss statement. We'll go through how to find a profit and loss statement and how to read it and how to understand it. And if Amazon released their earnings this week, well, you might actually go out and read Amazon's profit and loss statement. That way you can apply what you learned. It's the same thing in the real estate classes. You will learn and apply what you learned in the real world, because all these lessons are live. The coaches that we have teaching in Market Insiders are real investors. These are people who have been investing for years and have hundreds of thousands, if not millions of dollars invested themselves. So they're talking from their own experiences. And it was very important to me to keep this program affordable. I mean, it costs less than the price of dinner for two, and you really don't have to take my word for it, because you can try out Market Insiders for free. We have a free 10-day trial where you can go through the entire Market Insiders program. As soon as you enroll, you're going to get access to a stock market class for free that will walk you through the basics of stock market investing. You can attend the coaching calls. You can ask questions in the private community. You can network with other investors. This way, you can go through the entire program. You can try out, and then you can see if it's worth the money or not. If you don't like it, if you hate it, well, you don't lose anything. You don't have to spend a penny. But if you want to continue, then you can decide if it's right for you. So if you want to learn more and try out Market Insiders with our free 10-day trial, I'll put the link to how you can join in the description below. Now, on the protectionary side, the way that you can protect the value of your money, your wealth, is by converting some of your dollars into some sort of inflationary hedge, something like a commodity, like physical gold, because now gold takes time, effort, and labor to mine, to produce, so it's a real store of value. Now, the thing that you have to understand about gold is that it doesn't always go straight up. You see fluctuations in the price of gold, but when people start to get worried about inflation, then you'll see more people convert their stocks or their cash into gold, and so that could cause the price of gold to go up relative to the value of the dollar, as long as you see more inflation. Bitcoin can be another inflationary hedge. Now, I'm not going to go through the whole education of what is Bitcoin, how it works, and is it an inflationary hedge in this video. I've done tons of interviews with very successful cryptocurrency and Bitcoin experts. I will link a video for you in the description where I go over that. But the thing that you understand about Bitcoin is you have your risk of volatility. You can see huge upswings and downswings, and there is a lot of speculation involved with that, but it can be a potential inflationary hedge if you believe in the power and future of Bitcoin. And then you have the other inflationary hedge in cryptocurrency through stable coins. Stable coins are are cryptocurrencies which are stable. Some of them are pegged to the value of the US dollar. So one stable coin is $1 US. And if you take these stable coins and you put them in the specific institution that will pay you interest, an interest-bearing institution, well, now you can earn 7, 8, even 9% a year in interest on your stable coins, and you can cash out of your stable coins and move them to dollars anytime you want. Remember, one stable coin is supposed to be $1. Now, this has its own fair share of risks. You can see your stable coin go down. You can see the institution where you were keeping your money go down. So you have to do your own due diligence. But that is another way to protect the value of your money against inflation, because now you can actually earn some interest on your dollars and you can convert these stable coins back to dollars anytime you want. So that is one way that you can store your cash as you're waiting for a place to invest it. It's one place where I have moved a big chunk of my savings as I'm waiting to invest it, because now I can actually earn some interest on my savings, and now I'm just waiting to invest that money. I own physical gold, I own some of these stable coins, and I own some Bitcoin. But before you go out and do anything, just remember that investing has risks. You are never guaranteed to make money when you invest. You might even lose money, which is why you need to always do your own due diligence and never blindly listen to a random guy on YouTube. Everything that I say and talk about is just my opinion. And so you need to make sure that you're doing your own due diligence. That way you can do something that's best for you. If you like what you saw so far, then you're gonna love this. I grew up being told that if you wanted to become successful or rich financially, all you had to do was become a doctor and then save a whole lot of money. My parents are immigrants from India, and so I grew up with saving in my blood. Savings? Are you there? Here's the thing. If you work really hard and you earn $100 and you save this money in the bank, what are you actually saving? I mean, it took you effort and labor and work to earn this $100, and when you save this money in the bank, what do you end up actually saving? I'll get to that in just a minute, but before I get into answering that question, let me show you this. Let's assume that you have a nice job where you are earning $50,000 a year, and in order to earn this $50,000, you're working 40 hours a week for 52 weeks a year. So you're putting in 2,080 hours in order to earn this $50,000 of money. Now, what you have to ask yourself is, what is this $50,000 that you're earning? I mean, it's $50,000 worth of money, but how much effort is really required to earn or create that $50,000 that you had to work to earn? Because the government can create or print that $50,000 before I can even finish the sentence with just the push of a button. So Robert Kiyosaki, the author of Rich Dad Poor Dad, really made popular this idea that our money, these dollars that we work so hard to earn, is fake, because our money, or what we call money, is not backed by gold or silver or anything tangible. This money is just paper, and we work so hard to earn this paper, while the government can just print this paper with the click of a button. If you want to see his explanation as to why he thinks money is fake, I will link that for you in the description below. But it's kind of hard to imagine that our money is fake, because this is the money that we use to pay our rent, to buy our food, and to buy our vacations. But the question that you want to ask yourself, especially now more than ever, is what are you working for? You say that you're working for money. Okay, but what is money? Is it that paper $100 bill that I have? Right now, at the time of me recording this video, the United States has right around $28 trillion worth of national debt, and we are on pace to hit $78 trillion worth of national debt in just a few years. Now, that probably just seems like a random big number, because it's really hard for our brains to comprehend what $1 trillion is, so let me try to break it down. Let's assume that you can count $1 in 1 second. If you could do that and you wanted to count $1 million, it would take you 11 days. Now, that's probably not something you want to do, but you could do it. If you wanted to count $1 billion, it would take you just over 31 years. Again, that's definitely not something you'd want to do, but you could do it in your lifetime. But if you wanted to count $1 trillion, that would take you 31,000 years. That's not something you could do in your lifetime. Now, if we multiply that by 28, which is $28 trillion, the amount of national debt that we have, that means it would take you almost 900,000 years to count the amount of national debt that we have, and we're on pace to triple that in just a few years. So what is my good friend Benji really worth? No hard feelings, Benji. Well, money is supposed to be a representation of worth. If your time is valued at $20 an hour and you spend an hour at work, then you earn $20. That's also supposed to make spending money pretty straightforward, because if you want to buy a $100 scarf, that means you got to work for 5 hours to earn $100 to afford the scarf. The tricky thing now is that the value of our our money can be manipulated. Back in the day, our dollars used to be tied to the value of gold. And let's assume hypothetically that an ounce of gold is worth $20. So if you put in an hour work and you made $20, you effectively made 1 ounce of gold worth of value. These paper dollars were really just a paper representation of how much value that you created that you could see through how much gold that you were entitled to. If you put in 1 hour of work, you're entitled to 1 ounce of gold. If you put in 5 hours of work, you're entitled to 5 ounces of gold. So this creates a benchmark of value because not only does it take you time and effort and labor to earn that $20, but it also takes time and effort and labor to mine 1 ounce of gold. So it was a lot easier to define what $100 was worth because $100 was worth whatever it took to mine 5 ounces of gold. But then in the 1970s, our dollar was taken off of the gold standard, so our dollars became just paper.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
That's when our dollars changed to something called fiat currency, and I'll just read you the definition of what that means. A fiat currency is a national currency like our dollar that is not pegged to the price of a commodity like gold or silver. The value of a fiat currency is largely based on the public's faith in the currency's issuer, which is normally the government. So this money that you're working so hard to earn is not backed by gold or silver or anything tangible. It's just a piece of paper that's backed by the government. Now, lucky for us, the United States is the most powerful country in the world. It has the most powerful military presence in the world, and it has the most powerful economy in the world. Before we go any deeper in this, let me just make sure this is clear. I'm not trying to promote any conspiracy theories. I just want you to understand how your money works. That way you can learn how to use your money the right way, because that's what financial education is all about, and that's what we talk about on our YouTube channel all the time. We talk about investing your money, saving smartly, and using your money the right way. Well, if you don't understand what your money is, then the financial education doesn't really have that much value. When your dollars are not backed by anything tangible, it makes it very easy to manipulate the value of the dollars that you're working so hard to earn. I'll show you what I mean. So let's go back to this example where now I'm working really hard to earn $50,000 a year. So this is me, and I'm going to work every single day. Gotta draw me a nice mustache. I'm going to work every single day so I can make $50,000 in a year. And let's assume, for the sake of this example, just to keep things simple, that there are only $500,000 in the entire world. So I worked really hard to attract and earn this $50,000, and there's only $500,000 in the world, which means I control 10% of this country's buying power of this dollar. So I own 10% of the wealth because that's what I worked hard to earn. Now here's the thing, if these dollars are just paper and the government comes out and they say, you know what, we're going to increase the money supply and we're going to change the amount of dollars out there from $500,000 to $1 million, they have just increased the money supply, and if I don't get any of that, now I don't have 10% of the world's wealth, I only have 5% of the total buying power or world's wealth, because the amount of dollars out there just doubled because the government decided to print more money and inject it into the economy. And unless I get some of that, I just became poorer because I have the same amount of money when there's more money out there. Now, if I wanted to go out and buy myself a side of extra guac that used to cost $5 when there was only $500,000 in circulation, I'm gonna need $10 in order to buy the same side now, because you need the same kind of percentage, the same amount of wealth, the same amount of value in order to buy that guac, because now there's so many more dollars out there. It might sound like a crazy example, and yeah, it's a little bit simplified, but that's kind of how our monetary system works. Our money supply is controlled by our central banking system, which is known as the Federal Reserve Bank, and the Federal Reserve Bank has the ability to print money. So when you hear about things like the rising national debt, and you hear bailouts are happening, you hear about stimulus checks, what that means is the government is going deeper into debt to fund whatever it is they want to do, and in order to fund their debt, they're working with the Federal Reserve Bank to print this money, and then the Federal Reserve Bank gives this money to the United States government, and then the United States government then injects this money into our economy. Could you imagine if you had your own money printer? I mean, you could walk into the mall, go to the Gucci store, and see that $400 scarf and say, oh no, I don't have $400. Let me just print a few $100, boop, 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 $400 come out, now you just got yourself a new Gucci scarf. You and I, unfortunately, don't don't have the ability to do that because we have to work to earn this money, but the Fed can just print money. This money printing does have consequences because now you need $2 to buy you what $1 could before. This is what inflation is. This is why your rent keeps getting more expensive. This is why your groceries keep getting more expensive. You need more dollars to have the same buying power that you had before. In the beginning of this video, I talked about why traditional financial planning methods like just saving all of your money is not such a good idea anymore because of all the money printing that's going on. And that's because now, as more and more money is printed, savers become losers because the value of your savings keep going down because each dollar cannot stretch as far. As more money is printed, the buying power of each dollar that you save goes down. If you work really hard and you live below your means and you save $10,000 to help fund your retirement and you want to be risk averse and you don't want to invest this money, so you save this money in your bank, that way you know where this cash is. Well, the $10,000 that you save isn't going to have the same amount of buying power when it comes time for you to retire. Like if you saved $10,000 back in 1970, that $10,000 in 1970 would have gone way further than it will today. Like today, you would need about $70,000 to buy what $10,000 could back in 1970. So you save this $10,000, but each and every day, the buying power of the $10,000 is slowly dropping. Now, practically speaking, this doesn't mean that you shouldn't save any money. There is value to having savings, and I'll get to that in just a minute, but you need to understand what this really causes. So when the Fed prints money, they need to get it into the economy. And there's a couple ways that they can do that. So the Fed is printing some money, and the first main way that they get this money into the economy is by giving this money to banks, because banks are really involved in the money supply, and so if banks have more money, they'll be able to lend more money. The second way that you can see this money injected into the economy really only happens during crisis times. This is what you saw happen in 2008 and during the 2020 recession, where money can be injected into people through stimulus checks, or it can be given directly to companies through bailouts. So one way this money gets into the economy is through banks, and the other way is through a direct payment either to people or to businesses. But let's dive a little bit deeper into this. So interest rates are cut and banks have all these incentives to lend more money. So what happens? Well, you see two types of people. You see people like, number one, who go and borrow money and then they go out and they buy assets. So these are people that are going out borrowing money from the bank at low interest rates, and they're investing this money. Maybe they're buying businesses, they're investing into real estate, whatever. They want to get this money from the bank. That way they can make themselves richer. The other type of people, let's call this person number two, they use this money from the bank to make them broker. They're buying liabilities. So now you have these people going to the bank with all this newly funded money, and they're borrowing this money to buy a new wardrobe on their credit card, or they're buying themselves a new car, or they're buying themselves a nice fancy vacation. So now they're making money just for the bank, because they're borrowing money, buying things that don't make them any money, and now all this money and this interest is going back to the bank while leaving this person broke. Now watch this. There's a bigger pool of money in the world because there's more money that was printed, and this person is using this money to buy more assets. They're buying things that make them more money, and so they own a bigger share of the entire kind of money pot, while this person is spending all their money to buy things that lose them money. So if you even just had the same amount of money as before, you're effectively poorer than before, because now there's all this other money out there and you don't own any of the other money because you use all your money to buy things that lose you money. So this person is owning a bigger share of the pot, while this person is owning a smaller share of the pot because more money is being created, and this person buying assets is buying the things where all the money is going, and this person is the one paying for all of these assets to grow. So now you're seeing a bigger divide between the rich and the poor, because the people that understand money are the people that are buying assets, and all this new money is flowing into the assets, while the people that don't understand money are effectively becoming poorer, because even if you have some savings, your savings are not stretching as far, and if you have a job, your earnings are not stretching as far, and all of your money is going out back to the bank because you're not using your money to buy something that's actually going to make you wealthy. You have all your money going out. But it gets a little bit worse, because watch this. Now when you have these direct payments, it's going to go either to a business or it's going to go to a person. So a person would be through a stimulus check, a business would be something through a bailout. When a business gets free money through a bailout, guess who wins? It's the person who is investing in the business. It is not the average person, unless you're working for that company. But in general, if a business is getting bailed out, the people who are winning are the people who own the business, and I guess the people that work there because they continue to have jobs. So this helps the asset owners, the people that understand money. The person who gets the stimulus check, what do? Well, they take this money and then they walk on over to Amazon, or they go to Walmart, or they go to Kroger, or they go to Lululemon, or they go to Apple, or they go to Chipotle and buy themselves some extra guac. So you take this free money and you spend it back here. I'm gonna draw this kind of a convoluted way, back at the businesses. So you made this free money, this more money was injected into the economy, you got it, and then you give this money to the businesses. Now when the money goes to the businesses, guess who's winning again? It is the asset owner, because when you own assets, you are the one making money when everybody else is spending money. And so now what's happening? You have all this more money that's created, all this more money that's printed, it's injected into the economy. Now you have way more dollars out there, but more of these dollars are getting funneled to the top, to the people that understand money. Because now when people make money, or when people get this free money, they spend it. And where do they spend it? At businesses. So now businesses have a bigger share of the pot because there's all these dollars out there and all these dollars flow into the businesses and people are spending all their money at businesses. So now businesses have a bigger share of the pot, and the people that understand money are the ones that are really benefiting because they're owning the assets. They're the ones that own the businesses. They're the ones that are investing in the businesses. They're the ones that are investing in assets where the money is flowing, versus the people that don't understand the system are becoming poorer and poorer, because now, even if you have the same amount of money as before, it's a smaller percentage of the pot, so you're effectively becoming poorer because you don't own as much as you did before. Now your dollars don't stretch as far, your savings aren't as powerful, and your earnings don't buy you as much as they did once before. Now going back to the whole idea of saving money, we are seeing the lowest interest rates in the history of time. Now that's good news if you're a business or for somebody that's using this money to now make yourself more money. And it's, I guess, good news if you're this person because now your debt is a little bit cheaper, but in reality it's really not so good news because that means you're just becoming poorer because you're using more of your money to buy liabilities because you think you're saving money when in actuality you're actually just becoming poorer. But the real issue now is if you're saving your money, you're not getting any return on your savings because banks, when you have lower interest rates, banks pay you less interest on your savings. So when interest rates go down, yeah, you get a lower interest rate on your mortgage, which is nice. You get a lower interest rate on your credit card payments, which might be nice. But the issue now for your savings is your savings aren't growing either. Your savings are still, they're flat, they're dead. They're not doing anything. And so when you save $10,000 in the bank, after a few years, your $10,000 only earned you a few pennies. Let me diagram what this means. So here are your savings over time. Your savings are flat, they're dead. They're not growing because banks are not paying you any interest on your savings. But at the same time, the price of everything around you, your rent, your groceries, your healthcare bills, your vacations, everything else keeps going up because of inflation. We just talked about this. As more money is printed, the value of your dollars go down, which makes the price of everything around you go up. This is not a secret. This is public information. The Fed is openly saying that they're working hard to increase inflation. And so when they say they're trying to increase inflation, that means they're working hard to print more money to make the price of things go up. While at the same time, you know that your savings are not growing at all. So your savings are dead, the price of things keep going up, which means if you're saving all of your money, you are effectively becoming poorer because your money's not doing anything while the price of everything keeps going up. So what does this mean for you? Before I get a whole herd of comments of everybody saying, "Oh, Jasprit, are you telling me not to save any money?" Let's get this straight. Saving your money is important. You need to have an emergency fund. You need to have savings to protect you from an emergency, but you need to understand why you're saving your money. Saving your money is important as a financial cushion to protect you from you losing your job, from a financial hardship, from a crisis. That's why your savings are there. Your savings are there to protect you from going into debt when something goes wrong. If you want to be a small saver, then your goal should be to save something around 3 months worth of your expenses. If you want to be in a good saving spot, then you want to save about 6 months worth of expenses. And if you want to be an aggressive saver, then your goal should be to save 12 months worth of your expenses. So if you're spending $3,000 a month, just calculate it out. Now what you need to remember is why you're saving your money. Your savings are not there to make you wealthy. Your savings are there to protect you financially. Once you have your savings locked, now you need to really be investing your extra cash because you want to be on the winning side of what's happening financially. This could mean investing in real estate or businesses or stocks or commodities. It really just depends on what your investing goals are and what your risk tolerance is. The whole reason you want to be investing your money is because now you want to be the person that's owning the assets. So if more money is printed, this money flows into your assets, which makes the value of your assets go up because of inflation. And now you're on the winning side of inflation. That way you're not getting abused by the financial system. And if you do want to learn more about how you can actually start investing your money in different ways you can invest your money right now, I will link a video for you in the description below. So you think that Bitcoin, Ethereum, these have the opportunity or ability to 100x in the near future?
The entire space, not just one coin. Everything you touch, basically. Now, there's going to be winners and losers. So that's the financial incentive of why this matters. But it matters at a much deeper level.